Hello and welcome to Your Business, Your Wealth. My name is Paul Adams, and I'm joined today by Corey Shepard, a man who makes looking young as easy as he makes living a good life look easy. Good morning, Corey.
I wasn't sure where you were going with that metaphor. I'm still not sure, but it's good to be back. It's been a while.
I'm never sure when I start how it's going to finish.
That's one of my favorite Michael Scott quotes from The Office. Like, sometimes I start a sentence, I don't know where.
I don't know where it's going. I'm just going to get there. Yeah, it's a fine point. Yeah, you've been gone for a bit. I was gone for a bit. So we're glad to be back with all of you. I do think it's important. I didn't talk to you about this before, Corey, but
as usual, I'm used to it. That's fine.
Just bringing everybody into the fold here to talk a little bit about the beard.
Whose beard? Yours or mine?
I know it's tough for our audience to figure out, but in this case, we're talking about mine. So I was at a conference in Charlotte, North Carolina, and I was talking to my wife on FaceTime, and with a down angle, as outrageous as this beard's starting to look, it looks dang near ZZ Top when you're holding an iPhone down here. And I said, honey, this thing's getting long. I should probably trim it. She says, I love it more every day. And I was like, well, so we'll see how long it gets, guys, until Kristen is upset about how it looks. We'll keep going and see.
Rip Van Winkle knee beard might be in our future.
I don't know. That'd be something. I'm afraid I would get it caught in my zipper or something if it gets too long, which would be an awkward thing to have to explain to a firefighter. Today, speaking of things that are difficult to deal with in life, we're going to be talking about FOMO. FOMO with yo momo, with your money. Like what goes wrong in our lives when we end up in this fear of missing out? We picked a few popular articles that really speak to this idea of FOMO and the poor decisions we can make, and we're wrapping this one today with a very famous athlete that give you some insight about how you can avoid getting FOMO'd.
Right. I like how this
yourself.
Advisor in this article calls them animal spirits.
I thought that was pretty funny.
Yeah.
So that's our first is from CNBC. The fear of missing out can be a killer for investors. Here's how top-ranked financial advisors keep it at bay. Now, we're not so much worried about the advisors that refer to animal spirits when referring to their clients and the client's financial decisions, but it is an incredibly important skill. And a book, one of the quotes that was my favorite from this, Corey, it sounded like you picked up on it too, is first, we should give you guys the definition. A group of British psychologists define FOMO as fear that others might be having rewarding experiences from which one is absent. And then this Josh Brown calls them animal spirits to describe when people let their emotions guide them on their investing. Now,
and social media is absolutely it's not the original inventor of FOMO, because that still happened hundreds of years ago when you heard someone else got an invitation to the ball at court and you didn't get to go or whatever, right? That it was happening forever, but social media has turned it up to 11, and we only see the best parts of other people's lives on social media. So we always feel like it's way more glamorous. They're having way more fun, eating better food, even though that might be the one thing all week that was good compared to anything you're experiencing. So it's crazy.
And if you read much just about the, some past investment debacles, you know that some things like FOMO are real because of what happened during the tulip bubble and what happened during the East India Trading Company and their stock rise and valuation and how it crashed. And this goes back. Babies. Yeah. I was going to say hundreds of years ago until you got to Beanie Babies. But yes, why were people doing that? And it's because they get excited. Now, you guys have heard of Morgan Housel. He's the guy that wrote The Psychology of Money. And one of the things that he mentioned, and I wouldn't have thought of it this way, but I respect it because of how well thought through The Psychology of Money was, is that it is probably the most important financial skill these days in the social media era. Now, I think of it as being important for multiple reasons. One is your lifestyle. That if you're sitting there wrapped up and thinking about, what are other people doing or what am I missing out on, then you hear your friend who put a deposit on the newest electric car.
Or truck.
Or sports car or vacation or whatever. So your lifestyle can be a big part of it, where you're going to sit there and go, I want to keep up with these other experiences other people are having. And that, I would say, is kind of more like a slow bleed. Because if you make certain lifestyle decisions that aren't because that's how you wanted to live your life, but unknowingly, subconsciously, you wanted those things because you saw other people had them, then that's like a slow bleed. The arterial spray is the investment decisions that get made. Mm-hmm. Because you will put an amount of money into an investment that is far greater than something you'd pay for a sports car. Because there's an anticipated, sometimes only alleged positive outcome that's going to come from it. Because we not only have the stuff where there are people that are our friends that we hear about, but we don't think about that in social media, there's all kinds of influencers that are jumping on that train as well.
And, the problem is you don't know how good at judging what happened someone else is that's posting on social media. And, I just think of cases where people don't have to lie. People don't have to be lying to mess you up. They just have to be mistaken or not completely educated about it. And I've seen, I try to limit my social media intake, but I do get on from time to time just to keep tabs on what's happening in some different circles and different people out there. And I've seen folks who, and it's not even that they're clients, but I just have had conversations with people. I know a little bit about their background, and they post something on social media that is making a really strong claim. And I'm like to myself, I guess it could be true, but everything I know about that situation is probably not quite that big of a magnitude. But you see it on there and it's like, oh, and I don't think they're lying. I just think they don't realize all the elements that they're leaving out.
Yeah, that's a great one. And now think about what that happens in social media. Here, Corey is a competent professional, specifically in the business realm, sees somebody posting what I'll refer to as humbug, which in the 1800s was the same as saying bullish today.
Yeah, right.
But the humbug is that they're not lying, meaning they know the truth and they're saying something different. The humbug, the BS, is they're actually just saying what they're saying to trigger a reaction in their listener. Their attempt is not even to be true or to tell a lie. The person who's BSing doesn't think about whether it's true or a lie. They're just like, what they said works if it gets the reaction, and they're not even making the assessment about whether or not it's accurate.
Or they thought it was true and they're just wrong. And because unlike everything that we at Sound Financial Group post for the general public, most folks on social media have no responsibility to any accuracy of anything that they put out. And we have to put all of our words through a filter to make sure we're not making extraneous claims, promising things that aren't true. Like, we have to have that responsibility because of our licensing. So it's a really big difference.
And here you are, a competent, seasoned professional, owner of a successful registered investment advisory firm. And even if you see something that you know is BS, do you then put in the comments, this guy's full of it? Of course not. Because then you have the liability. That's the thing. The very people that could sniff the BS don't say somebody's BS publicly online. You don't see their mentions getting blown up by competent professionals because the competent professional doesn't need the blowback from whatever that's going to be. So keeping in mind that just because everybody's really excited in the Strand may just mean a bunch of really competent people like Corey just kept scrolling when they saw it. Now,
back to the article. A couple of things on here that are fun. Like, I think anybody who's listening to our podcast has probably heard something about the fervor around crypto over the last several years. Like they're fairly familiar with that one. SPACs, special purpose acquisition companies, are touted as the next big new thing. And they are a newer thing, but really it's just a different way for a company to go public, essentially. It's not giving us anything new under the hood, like which crypto is. It's just a different organization than a mutual fund or a private equity fund for what's the same thing at the end of the day that we've had. So it's just a new wrapper on something old, but that's all we need in the financial industry is a new wrapper to get people all excited about something. And it's not anything different than the thing that it was yesterday, but because there's a new wrapper, people are treating it differently. I think that's curious as well. There's literally no reason.
And given that celebrities also push some of these SPACs, that brings a whole new meaning to what a new wrapper is. There might be a new wrapper promoting a SPAC, so it's not just a new wrapper they put around it; it's also the new wrapper they put in front of it. But I did like this. This is something that I think is wise words. Celebrity, like anybody else, can be lured into participating in a risky investment or may be better able to sustain the risk of loss. I think the SEC is being polite. I would add, don't listen to celebrities about how to run your life or investments.
Because celebrities, basketball players, which we're going to get to in a minute, Steph Curry, as much as I would love to invest in Steph Curry's Steph Curry restaurant, like just all curries all the time. So I think there's something there, right? Like that name alone, that could, no, I'm not giving investment advice. He doesn't know. He's a basketball player. Just because he has a lot of money in one domain doesn't mean he has any experience in another. And basketball players, any professional athlete, are notorious for frittering away their money in bad spending or bad investments. So,
and I think to the point is like some of them could, quote unquote, afford to lose the money. But here's the question that this article asks that I think is relevant to anybody listening. And that is, if you're on track to have the level of success that you want, then why are you risking that future to have a little bit more? Mm-hmm. That's part one. Part two is, if you're in a spot where you've done the math and it doesn't look like you're going to make it, how to make it is not to play the lottery. Not to play the lottery in real life, like go to the gas station, get a ticket, but also not playing the lottery of what I need to do is get a bunch of home runs, because base hits will win the day. Ready for our next one?
I'm ready for the next one.
The victims of FOMO, rich young Americans, have lost confidence in the stock market, are betting on these three assets instead. Get in now. Get in now for strong, long-term tailwinds. I love the title of this article, especially the last line. Get in now.
Get in now. It creates a self-fulfilling prophecy that started in the first sentence of the of the headline.
Well, here's the story. According to a recent survey from Bank of America, individuals aged 21 to 42 with at least $3 million in assets only have 25% of their portfolio invested in stocks. For wealthy investors over age 43, the allocation to equities is much higher at 55%. So what they're saying is, people who are under a certain age that have over $3 million, so under age 42 or younger, with more than $3 million, tend to have less money in the stock market. Now, first off, I just want to give one quick, little bit of an aha moment. If you are under the age of 42 and already are worth over $3 million, there is some decent possibility that you made your money because, say, you were in real estate as a business. Yeah. That could be one. Or
any business, any business that you started. You probably didn't do it working 9 to 5 for someone else.
That's right. Yep, exactly right. So you have some bias that's already existing, and just so you have a certain net worth under a certain age, a certain portion of that might more likely be in ownership in their own company.
And you think you make a good point that it's very likely they have some kind of real estate involvement at someone that age, making wealth that quickly with leverage. Usually real estate gets involved if it's not some other business. And then over 43, well, I mean, that just says over 43. So I'm assuming that includes everybody over 43, up to 65, 75, 85. And someone who's 65 or 70 with
over
$3 million.
43 and not dead yet. Over 43, not dead yet.
So there's a little bit of like correlation, not causation here, because you're 65 with $3 million of assets, then that's very different than a person who's 25 with $3 million. And that $3 million is producing a bulk of your income. It's going to be in lower risk things. It's not going to be in some private equity fund. Most likely it's going to be stocks and bonds, and probably bond or heavy. So it's kind of a funky statistic.
Indeed. But then let's look at this. What are the things that they're getting attracted to? Well, one is cryptocurrency.
Yeah.
Well, that's all well and good, but we know what's happened to that, where there's been huge drop-offs in crypto in this last year. Now, what's funny is, when did most millennials get attracted to it? It's not right now.
No.
And I can tell you, because we have folks as clients, and in 2020 and 21, we were answering crypto-related questions on the regular. This year, I don't think I've had anybody ask.
No one's asking about it anymore.
Right, because that's the problem, is FOMO, the fear of missing out. The very people who are like, oh, maybe I should be in it, maybe I shouldn't, might have picked up their head once and said, oh man, I'm glad I didn't do that. Or if they did it, they're now living in the story of, well, I need to stay and see what happens to it. I already lost 80% of my money. So then real estate is the next one. And now, real estate has been a popular asset of late, perhaps because it's a well-known hedge against inflation. Gene Pan, who wrote this, I don't know who Gene Pan is. I don't even know if I'm pronouncing it right, but that's the problem with the internet. Gene Pan, real estate's been a popular asset class because it went up tremendous amounts during the pandemic. People are not buying real estate right now going, hey, I think my 7% mortgage I'm going to have to buy this on is really going to help me with inflation. In fact, by every measure, investor purchases of real estate have dropped this year since the inflation indexes have gone up so much. So, but now let's talk about that, is that with real estate, if it's done properly, you guys have heard us talk about this on the show before, it's like you're buying a little business called this piece of real estate. And if you run it like a business, you can get returns like a business would. But if you try to buy a piece of real estate like you buy a mutual fund, it is not even in the same ballpark, which leads me down here. You don't need a landlord to start investing in real estate. You don't have to be a landlord. You can go into real estate investment trusts. And let me tell you, the return you get from a real estate investment trust is significantly diluted by all of the management structure that had to go into it. So if you were seriously thinking, I'd like to buy a small strip mall, or I want to buy a fourplex, or I want to buy a duplex, or I want to buy a single family home I'm going to rent, it is not an equivalent decision to buy a real estate investment trust.
Right. It's not, well, I'll just do it in this, like I'm buying it from Costco or from Target. It's like not
the same thing. Yep. And then last but not least, and Corey, it's so funny how these articles lined up. It's like, oh my gosh, private equity, like SPACs.
Right.
That basically what's happening is young millennials who have wealth, who have not yet had a chance to get seriously, and I mean this not in a bad way, not like they're totally naive, but as a group, they're going to be naive to investment losses. They just haven't been doing it long enough to weather a storm. They haven't had to weather a storm in real estate yet. That 2008 thing was before a lot of them got up and running in their careers. And many of them haven't really gone through a real recession yet. And they're about to. And every one of the things that they're pointing to invest are far more volatile than the one that's getting poo-pooed, the academically allocated, globally diversified investment portfolio.
You know, the theme I also notice in this is illiquidity. So crypto is pretty liquid. You can theoretically sell it at any time. There's no real restriction, although there may be some theoretical restrictions. But
yeah, if your crypto doubled this month, do you feel like you want to sell it now, or it's like, no, it's going to the moon,
Right?
And if it goes down by 50%, that's not the day you're like, now I'd like to buy my new car.
Yeah, right. But private equity and REITs often have some forced holding periods, or once your money is in, you don't get to choose when it's liquidated again. And so that's enough, for someone really young, especially, that's not really a great choice to make. Because and this is the over 3 million folks still, so maybe they've got plenty of liquidity, but it's worth noticing that you're trading something major for putting your money into those, which is access when you want it.
Indeed. Which leads us to our third article in this theme of fear of missing out. And this is not so important about the specific article, although, it is interesting. This guy literally ran a Ponzi scheme out of his frat house, basically. And why do people get seduced by, attracted to something that's a Ponzi scheme? I want you, just so you're listening, I want you to think about it before Corey and I speak to it. Why is it people get attracted to a Ponzi scheme? Is it because the person leading the Ponzi scheme has a super long track record of success that's been investigated by the investors and proven true? Is it because they have looked at the analytics of whatever trading algorithm or real estate investment strategy this person's supposed to be in and all of that, and it's really well vetted and did it? Or our third option, is it because the investment return sounds so good, I will feel bad if I don't put money in and these results come true? It's FOMO, textbook FOMO.
Bernie Madoff's clients, there's a lot of, after the fact dissecting it. Everyone just, the returns were so good, no one was stopping to ask where they were coming from because they were afraid of missing out on those returns.
And you know why they were afraid? Because when people asked and dug in with him, he very publicly gave them their money back and told other people they can't invest with me anymore. So he literally produced the FOMO. And that's one of the things that we have to be very careful about, and definitely point people to. When you hear you've got a friend who's got some really cool investments supposed to do really well for them, and they're introducing you to it, your friend has FOMO for you. FOMO you. FOMO others? I don't know. He's trying to FOMO you, but he doesn't know it. He's just excited, or she is excited and wanting to tell you about it. Point them to articles like this one. Just put in Google News Ponzi and just watch how many come up. And point your friend to go look at those things, because truth be told, too often people don't find out they're wrapped up in one until it's too late. And that FOMO blinds them to all of the things that you would later look at as red flags. So, how do we deal with all this FOMO? We're going to learn from a very tall man who played basketball very well.
Give him the bird.
Give them the bird is right. If somebody tries to get your FOMO, you give them the bird. Now, by that, if you're just listening, we mean Larry Bird. From the Basketball Network. Basketball Network, Larry Bird remembers when players that later went bankrupt made fun of him for saving his money. They just laughed and make jokes about me stashing my money away. Larry Bird believed in hard work and being smart about money, which is the main reason why he always refused to give money away to players who went broke. Now, that's tough. Now, probably not tough for him to say no. Because after years of having people in the locker room give you a tough time because you did something different with their money than you did, you did something different that was responsible and other people just did whatever they did. When they turn around and ask you for money, it's probably pretty easy to be like, oh, no, man. I told, but he talks in the article about some of the advice he would give people.
Can I read this? I just I just fell in love with this. So, quote straight from Larry, and I'm definitely going to read his book bird watching. That sounds like great material. So even when I was at the top of my game, which he made estimates already made about 24 million in contracts with the Celtics alone in his 13-year career. So we're talking 2 million a year from the Celtics plus all of his endorsements. So even when I was at the top of my game, we didn't drive a Mercedes or live in $1 million homes. When I was first playing, we bought a nice little house, and it cost about $125,000. So he's making somewhere around $2 million a year, and he bought a house for $125,000. We didn't run out and spend all our money because we knew there would be a time when it was over, and I wanted to have options on what we could do with our future. I never thought about retiring. I just assumed I would always work. So I just think that like, imagine when everyone else around you is buying $700,000 houses, but they're making less than you. He knew he could flex if he wanted to, and he just took the teasing and took all the humbug that everyone was throwing his way. That's so impressive. And you don't hear stories about this.
No, not
Chad
at all.
Ochocinco going crazy on the field.
Yeah, if you look up, so let's say you went online and you decided you're a sports person, you're reading about all these athletes. How often do you hear stories about athletes being responsible? Or is it so-and-so got his 5th Lamborghini? Or so-and-so bought a $20 million home?
Yeah.
So every now and then you'll hear they had to sell it. Every now and then you hear about the epic meltdowns like Sprewell. But the problem is we don't get to hear these stories often enough. How often has Larry Bird been in the news, and how often has it not had anything to do with him being financially responsible? So during his career, Bird had several encounters with players that made less than him, but led an expensive lifestyle that soon ruined their lives and lives of their families, and they couldn't pay their bills anymore. Now, this is equally true for you.
Yeah.
The difference is in a regular career, the people around you burn down slower. That when you look at somebody who's a major athlete and maybe they have a lifestyle that takes $5 million a year and they've got all these homes and everything else and they're making $10 million a year and it's okay, right up until that income dries up and then it burns down in spectacular fashion. But if you're, say, about our age, you've been in the workplace for 25 or 30 years, and you can look around at the people who are crushing it at some point in the past, and they're just not crushing it like they were. Mm-hmm. It could be because the technology changed in the marketplace. Could be that maybe they had a medical thing and they fell off, all of that, and they've had to take a step back in lifestyle. But the real burn down is the retirement side, and we just don't see it because we don't see the kinds of assets people have. So when you're living humbly, when you're having good stewardship, when you're setting aside, I just met with a client of ours this morning, Corey, went through a big life change, got serious. He did the math. He is saving about 37% of his gross, comes to about 50% of his take home. That's him doing something nobody else is doing. And what that means is he's got to say a no to a lot of stuff and people. Some of the guys who've made far less than me bought $700,000 homes, Rolex watches, and big luxury cars. I used to tell them, you're crazy. You should be saving your money. They just laugh and make jokes about me stashing money away, but I could see what they were doing. They were throwing away their future.
What does that joke sound like, by the way? Like, I don't even know what that would be. Like, you're just...
I got it for you.
You squirrel?
You tell me I should be stashing my money away. I'm going to give it to you just like it happens in the locker room. You ready?
Yeah. No, I should...
You got to say, I should be stashing my money away.
You should be stashing your money away.
Oh, well, what are you, some Scrooge McDuck? I'm swimming around in your money bin. Man, I don't know how long this is going to last. I'm going to enjoy my life while I got it. Man, you handle...
YOLO.
You handle nickels like they're manhole covers. It's so hard to get you to spend money. It's almost like your arms aren't long enough to reach into your billfold. That's what it's like going to eat with you, Larry Bird. See, stuff like that. That's because that mindset is like, it doesn't make sense to them that somebody would be responsible. They just laugh and make jokes about me stashing my money away, but I could see what they were doing. They were throwing away their future. This is such wise words from Larry Bird. They were throwing away their future. So many of them were living for the day and not even stopping for a minute to think about 10 years down the road when their playing careers were over and the money stopped pouring in. And by the time they realized what I was telling them was true, it was too late. This is also equal for your career. For the people that Corey and I meet over just the course of our lives in business, where they're in their 50s and they say, where should I put $5,000 to get the best return? I was like, I don't know. Blow it on a bunch of weed and some cocaine, because it's going to do you more good there than that $5,000 is going to do toward your retirement.
And I'm just
joking. I'm just joking.
Anyone to
I'm just joking. I don't tell them to get weed. Go straight to the cocaine. I can't tell you how many.
You just stop at that first half of the sentence, and then we just let them imagine. That's
very good. I'll do better with the imagining. The problem is, Corey, my experience is people's imaginations are far worse than what I was going to say.
I know, that's right.
But the difference is people like you, and they don't blame you for what they thought they heard you not say. But they will send me hate mail for something they thought I implied that I didn't even say. All right. But here's the last one that I think just lands this entire conversation about FOMO so well. And that is, I can't tell you how many ex-teammates have asked me for money. It's heartbreaking for me to say no. But I do, because I warned them. I told them to save. Now, here Larry Bird is now near the end of, he's working his career still, but he's managed to hold on to $70 million net worth when he was playing sports at a time that athletes made a fraction of what superstars like him make today. And he managed to keep a hold of it. He managed to build net worth. He's built legacy for his family. He's built an identity as a business person beyond just the sports ball player. And for all of us, we're working on our careers, we're working on saving money, we're working on making good decisions. There's almost nobody speaking a marketing message to you or talking to you in the proverbial locker room about what they're going to buy or what they think you should buy with your money, who has your aims in mind. Period. It's why we have practices for finding out what our clients' aims are, because we need whatever financial decisions we recommend they make to get them closer to those aims. Most people saying the kind of car you should drive or the next promotion you should get or whatever, to a great, great degree, none of those people have any idea what your aims are. And yet they'll make fun of you in the locker room for doing the thing that cares for your aims without any conversation of even checking in about what your aims might be.
So my question is, are you listening to your Larry Bird or pushing them away? Because I think we all have them. Like, it's not going to be a professional athlete, but you probably have someone who, if you, with this new perspective we're giving today, if you can just take a step back and look, you say, oh, they're actually doing all these things right to have their future work out the way that they want. And am I listening to them, or am I making it harder and harder for them to speak into my life? Because they'll reach an endpoint, they'll just stop. Like we talked about earlier, the person scrolling through sees something that's humbug, and they're like, no, I'm just going to keep moving. Like, you only got so many shots for Larry to give you that advice before they just say it's not worth the trouble to try anymore.
Well, I think I might leave us off on a little story that just happened last night in a buddy's garage. We're looking around, he's organized his garage and his weight set and all that, but he has this really, really great motorcycle that's like I'm going to say the wrong type, but it kind of can off-road, but it could also, I think it's called touring bike, but I don't remember if I got the right, or if it's a something cross. Anyway, beautiful bike. And he's had it for about 3 years, put 600 miles on it. And he says, man, I just don't enjoy riding it because I want to do things with my family. And anytime the weather's nice enough to ride it, I'd rather go throw a ball with the kids or whatever. And I said, yeah, I was wondering why you bought that 3 years ago. And he says, why didn't you say anything? I said, you already bought it.
Yeah.
You see, the thing is, I don't say anything to somebody after they bought it, because the closest I've ever gotten to the like third rail in a relationship with a friend was after they bought the way too expensive pickup truck, paid retail for it, had big financing on it. And I said, well, what if you planned on keeping it 15 years, what would it have hurt to buy a 3-year-old one, pay half as much, and then do all your overlanding stuff to it? And then if you want, you just keep it for 12 years, but you'd still save a ton of money. And all of a sudden, the mood of the conversation changed. I was the problem, all that. So I just don't comment after people. And I told my buddy, I said, next time before you make a big spending decision, if you want my thinking on it, ask me before you do it. Because I'm telling you right now, I'm never going to be straight with you after you buy it, because there's nothing you can do about it after.
Right.
And the only reason I bring that up is, I think, Corey, it's so brilliant the way you brought up, find the Larry Bird that might be trying to whisper that to you in your life.
Yeah.
Because that person will also probably be a warrior for you being a great parent, an incredible spouse, a better business person. Like, this person's probably dropping some gems for you in other areas. And if you're noticing that somebody cares for you enough to say something about what you're doing with your money and how to be better with it, then not only is that somebody that's probably worth listening to, but it's also somebody you should probably refer to Corey Shepard almost immediately, because that person could probably use that up-leveling in the way they look at their investing if they've been doing it a traditional way. And as always, for all of you, do take some time to make a comment on this YouTube video if you're watching on YouTube. Give us a podcast review. Reach out to us. If you find a cool article while you're reading the paper, just go ahead and email it to us at info@sfgway.com. We'd love to hear those things. Some of these topics come from you guys as listeners. We appreciate our Sound Financial family. We're going to keep coming, doing this every week other than when we're traveling, because we care what happens to you. We care that you get a chance to watch for your Larry Bird. We care that you're going out of your way to be in a position where you're listening to something like this, rather than a topic that would get you deeper into FOMO and maybe into some bad financial decisions. Mm-hmm. Anything else before we send them off, Corey?
Nope.
And with that, nobody else at Sound Financial Group thinks this except Miranda. And Miranda wants you all to have this episode be a contribution to you being able to design and build a good life.